Welcome back to The Exchange. Disney is set to report earnings tomorrow after the bell. The company having a stellar few months, especially thanks to Disney Plus, but shares are flat for the year. Morgan Stanley thinks this could be a good sign, saying in a note that Disney is, quote, quiet as a mouse for now, but that it has a bullish trifecta in its future: parks, sports, and a strong content cycle. Joining us now is Ben Swinburne, head of U.S. media research at Morgan Stanley. Ben, I guess the bear side of this would be, hey, the stock ran in anticipation of the opening that we're about to see now. And stuff like the Avengers and Robert Downey Jr., Chris, that stuff is done. Yeah, the TV stuff is done pretty well, but we don't really know what's next for a lot of these franchises. Why is that wrong?
Well, look, I think if you look across media, the great stocks of the second half of last year, a lot of the reopening and a lot of the streaming, winners, look at Netflix as an example, they've underperformed, or in the case of Disney, just haven't done a whole lot. And, that's not a huge surprise given the rotation in the market that we've seen. But no stock benefits from a content cycle like Disney has. I mean, just think back to when Frozen came out all the way back in 2013 and how much that drove outperformance over the subsequent couple of years. And we are shifting now from an earnings model from selling tickets and generating, revenues over a relatively finite period of time to building a streaming asset wrapped around all this IP. And so while the market's focused on parks, which makes sense, and focused on direct to consumer, what I see coming on the content side over the next 12 to 18 months is pretty powerful, and I think could be a real catalyst for the stock.
Ben, are there questions now about how Disney will be run for the next 5 years? Because we had the CEO transition right as the pandemic was happening. The former head of parks is now the CEO. The guy who was running Plus is now out. And, to what degree does Disney need to show or prove anything about the way it shepherds films and kind of creates the right kind of flywheel around its brands going forward?
Yeah, it's a great question. I guess I'd make 2 points. One, on the content side, a lot of the key people who run their studio businesses are still there. Kevin Feige, for example, at Marvel, Kathleen Kennedy at Lucas. So I think, and we have Bob Iger still involved on the content side as well. So I think the content creative side of the business is in great hands. And then when it comes to Bob Chapek and sort of his track record, obviously we've had to watch this all happen through COVID, so it's hard to measure. But I would make a strong case that the Monday Night Football renewal that Disney recently announced with the NFL was a significant success point for the new management team in actually lowering the expenses relative to what we thought, improving the quality of the games, securing some Super Bowls, and creating an opportunity to put some of that content on ESPN Plus. So far, we're pretty happy with what we're seeing on that front.
Over the next year or two, what do you expect the stock to really move on? Is it going to be kind of this Disney Plus versus Netflix direct-to-consumer narrative, even wrapping sports into that? Or is it going to go back more to fundamentals, considering not just that, but also how the parks are run, the profitability there, some of the ways perhaps that they're able to extend that direct-to-consumer relationship beyond digital into some of the other revenue streams?
Yeah, I think you set it up well. I mean, look, this is a company that should grow earnings from not a whole lot this year to $8 to $10 by 2024. So it's a massive earnings CAGR, and that's coming from direct-to-consumer ramping, from parks reopening, and now we have a little less pressure on the sports cost side. But the big bull case, which is still, probably a couple years away, is how does Disney as a service emerge with all these direct-to-consumer relationships? I mean, if they hit their targets, you're talking about 300 million plus direct relationships with an internet connection, real engagement. And how does that make Disney, the company, more successful, more profitable than the collection of the businesses that we've been tracking all these years?
Now, you do point out some risks to the bullish case, and some of that involving pressures, economic pressures in Latin America and India. What's the next big test that your bull case sort of has to pass, or Disney has to pass, in order for your bull case to show that it's winning out?
Yeah, I think on the India, Latin America points, again, part of why the stock's been quiet as a mouse is we saw with Netflix, even a little bit with Spotify, that Latin America and India are in a tough spot, and these are markets that are expected to be big growth drivers for streaming. If anything, the situation in those markets has gotten worse over the last month or so. So near term, there's clearly some risk around those markets in terms of streaming net adds for everybody, including Disney. I think the big test is always content with this company. I mean, they've put the management structure in place. They've proven they can run a streaming business, but Disney is all about the content. And if they can show that Marvel and Star Wars and Disney live action and the princesses continue to resonate with consumers and drive consumer spending, that's the key.
Shepard Smith here. Thanks for watching CNBC on YouTube.